Well, hello and welcome to another episode of the Lending Podcast. We are your host, Jeff Jones, and I'm John Burnham. Thank you for being with us today. And we have an interesting topic talking about debt consolidation loans. We're getting a ton of questions about this lately. Home equity loans versus cash outs. And we're going to dive into the different products that are available and really when and why you should consider doing a home equity loan.
Yeah. So if you're out there and you're wondering, man, I have some debts I need to pay off, or it would be nice to have cash to do my next endeavor, whether that's, a business you've always wanted, home updates you've always wanted to do because you don't want to move yet, or something else that you want to spend some good money on. These are available for you now, and we want to talk through what to consider to make a good decision.
So true. And I think one of the most common questions we're getting right now, because credit card debt has really escalated in this country and it's at an all time high, we've touched on that before. There are a lot of folks out there with a tremendous amount of equity and yet feel married to their low interest rate, which we did a lot of those loans a few years ago. They're amazing. We have a lot of clients out there at 2, 3, 4% interest rates. And yet carrying right now maybe 30, 40, $50,000 or $100,000 of credit card debt. And I have a client right now we're working with, and this homeowner's credit card debt is $176,000. And we're going through the debt consolidation process. Now, why would you consider a cash out mortgage where you redo your entire mortgage versus a second lien home equity? And what does that mean? And what are all these different types of home equity loans? So we're going to dive in. There's actually 3 types of home equity loans.
Yeah.
We're going to talk about those today.
Yeah, that's good. So I'm excited about this one. A lot of people, kind of like myself, are house rich but cash poor, right? So they got a lot of equity in their home, but they have some debts. So this is for you because I think this is going to be insightful. So the 3 types, what are they?
So the 3 most common types is a home equity line of credit, and that is also called a HELOC. That is an interest only, in many cases, second lien on your house behind your first mortgage. You're not touching your first mortgage. You're just obtaining this line of credit against your home. It's usually on a variable rate, and it's usually, in many cases, interest only. And that's probably the most common on for clients that are getting a smaller loan. So maybe like $100,000 or less.
Yeah.
We see a lot of HELOCs. And we do have an internal product that we offer, although I also have relationships with other banks. And there are certain banks that really do HELOCs well, other banks that really do other loans well. So we help guide you through the process. But that's the first one is a home equity line of credit. The second one is very similar. However, it's a fixed rate. So if you're a little more risk averse out there and you don't want to be in a variable rate situation, then you can get a home equity loan, second mortgage, keep your first mortgage in place. You do a second mortgage. It can be a 5-year term. It could be a 10 or 15-year fixed. I think they'll go all the way up to maybe 20-year fixed on these home equity loans. And then it's a fixed rate, second mortgage. You can refinance those if rates go down every year. You can relook at it. And so we see that occasionally. And right now, because rates are elevated, I would make the argument that it's okay to take the variable interest rate because we should see that stair step down. And each month, if the rate changes, your payment would actually go down with that variable rate. So when rates were super low, folks got in trouble a little bit because there were clients that borrowed these home equity loans when rates were 3%. Now they've gone to 9%. And it's a little ugly, right? So, but if rates go from 9 back to 6 or whatever those home equity loan rates are, then of course that would be a smiley face. We'd see the payments go down. So home equity lines of credit is option 1. Home equity loan, fixed rate loan is a second lien position, option 2, in no particular order here. And then what we call a Texas cash out, which is a first mortgage, and we redo your entire loan balance. Okay, so let's say you have a balance of $200,000 right now. You want to borrow another $100,000. We'd redo that entire loan. You'd have one loan for $300,000, and you'd net the cash. And there are pros and cons to each one. We're going to dive into a little bit here and talk about why we might do one versus the other.
Yep. And so, the simple version is of, a home equity line of credit is just a line of credit. You can draw on it, pay it back, draw on it again, pay it back, draw on it again, pay it back. So it has an ebb and flow to it,
Yes.
right? and it gives you a cap of how much you can draw, right? Like you have availability to draw 100,000, but you only need 10. You're gonna draw 10, pay that down, and then maybe you need 50,000 another day. You don't have to go out and redo all the paperwork. It's there for you with that bank that you used. The loan, like you said, it's just another loan, just like your current mortgage is just a second one on top of it. And then the third one is instead of having two pieces, it all gets mushed together and you have one loan again.
That's right. Yeah, and I think a very important concept, the numbers that we're going to run to determine what's best for you is based on a phrase called what is your blended rate. So the blended rate is going to be important. So let's take a for instance, right? So let's the client that I'm working with that has $176,000 in unsecured debt right now. It's very strangling for her. There is a lot of interest on that 176,000. Her average interest rate is over 20% on that. So if you think about it, she's paying $3,000 a month in interest. That debt it'll be very hard to ever pay that back, right?
Right.
And this is a fixed income borrower in her retirement years, right? So what we're doing is taking, yes, she has a 3% mortgage, 3% rate on her mortgage right now on her first mortgage, but we're taking that rate, we're going to replace it with a new mortgage, pay off the 176, she'll end up with about a $500,000 mortgage, and her overall payments or outflow on a monthly basis is going to go down $2,000 a month, and she's going to have better tax advantages as well because of the interest payments. So that's just one example of, in her case, it made sense to redo the entire loan. We looked at that blended rate. What's she paying on the first mortgage? Let's say 3%. What's she going to pay on a home equity line of credit if she could qualify for it? Because that's the other piece. Sometimes may not be able to qualify. That was going to be nearly 10%. And when we did the blended calculation and the tax advantages, it made more sense to do one loan, call it Texas Cash Out, so that she could pay off her debts and then lower her overall outflow.
Yeah. So I want people to realize, as we talk through these things, these are what a good loan specialist will do for you. So they're not just going to look at what a cash out will give you, what a home equity line of credit will give you. We're looking at blending those two, like the two differences. So when you have a home equity line of credit, it's not just that rate on that one compared to the rate on a new cash out. It's blending your current with the new so that those two things that are both on your house really become one debt, right?
Yeah.
Because it's on your home. So you're paying those both at the same time every month. So it's essentially you're making two payments for one purpose.
Yeah.
And what we like to do is that math game that a good loan specialist or strategist or loan officer should do for you, which when we look at the two options, what is your total monthly payment and what rate are you paying on it? So we always want you to basically get the most amount of cash back for the least cost.
That's right.
That's our math. And we do that with our blended rate scenario comparison.
Yeah, and one nice thing about the home equity lines of credit, in many cases, the closing costs are very minimal. So
Right.
you're actually netting more cash. And let's just use that same, for instance, let's say this lady only had $50,000 in unsecured credit card debt versus 176. Well, we probably would have leaned towards the home equity line of credit.
Right.
Let's do a second mortgage, 50K, pay off that credit card debt that's at 20 something percent. Let's get you down to 8 or 9%. By the way, home equity lines of credit are directly tied in many cases to the prime interest rate. So as of today, the prime rate's 8.5%. So a lot of banks will do prime plus a half or prime plus one.
Right.
So 9%, 9.5%. So you look at that 9.5% second mortgage and you say, well, that's a high interest rate. Yeah, but it's less than your 25% credit card debt. But then you can keep your 3% mortgage in place if your desire is to stay in the home.
Yeah. No, that's a good thing. So for people to know about the home equities loans and lines of credits, they are a different animal than the mortgage industry, essentially, because they're traded differently.
That's right.
Right. So they're on a different exchange. So those rates do not correlate. Like you said, a lot of times those bank institutions are writing them on prime plus. So we don't do that in the mortgage industry. So it's a different animal. So that's why the prices are different. It's usually a shorter return. So they're trying to get their return quicker, which is why it's usually a higher majority wise, because they're trying to get their money back faster.
It's also a higher risk.
And it's a higher risk.
It's a higher
That's
risk
right.
because they're in second lien position.
So they don't get paid off first. That's what
correct.
that means.
So they're at risk. Now, they're mitigating that risk by limiting how much equity you can tap into.
That's good.
So let's talk about Texas, because Texas is a little different from some other states.
Right.
And of course, we're based here in Central Texas in the Austin area. And in Texas, you can borrow up to 80% of your home's value. So if you have a $500,000 home, you could borrow up to $400,000, right? So if your initial mortgage, if you owe a $300,000 loan right now, you could tap into $100,000 in equity, that delta between 80% of your value and what you currently owe. Now, the interesting thing, I think, in this industry with Texas lending is we'll loan you 100% of the money if you're buying the house in many cases, right? We have USDA loans, we have VA loans that do 100% financing. We have FHA and conventional where you put 3% down or 3.5% down, or maybe you got down payment assistance, you got 100% financing. So there's all these different tools and strategies that we love to help our buyers get into a home for little to no money down. However, the downside to that, I don't know if there's a downside per se, but if you are in the home a year or two and you put very little money down, now you find yourself in a situation where you'd like to tap into your home's equity. You're only able to if you have more than 20%, right? So if you bought a $400,000 house, you put 3% down, so you owe $388. That house would need to appraise for $500,000 for you to tap into that remaining, maybe 12 or 15,000 in equity that's available, right, for that 80% calculation. So really important for our homeowners to know out there, if you've recently bought your home, you may or may not be eligible for these home equity loans because it's capped. We'll loan you higher money on the purchase, but on the refinance, on the cash out, you're capped at 80%.
Yeah,
really important.
And the value of the home is not evaluated based on your purchase price of when you bought it. It's based on the appraisal as of today when the appraiser is done. So an appraiser will go out to the house and say it is going to be worth X right now, today. Not what they bought a year, 2, 5 years ago. It's worth this much now. It's not what's tied to your appraisal district's numbers from the county. They're very different. So people need to know, like, you might have 80% and you not know it.
That's right. And you might have got a really good deal in the house when you bought it. Perhaps you bought it with a really good value, or you might have bought it from a friend or family member and you had some built-in equity. You could come back and cash out. There are some guidelines, of course, whether it's investment property, whether it's second homes, whether it's owner occupied. But generally speaking, on most guidelines across the board, you're going to be capped at 80%. Certainly on an owner occupied, you're definitely capped at 80%. Some of the other loan products may cap you at 75% of the value if it's investment or second home, just based on the costs and the interest rates and those types of things. Now, the less you borrow against your house, the better your terms could be. So we also want to look at how much do you really, really need, because you can borrow up to 80%, but if you really only need 65 or 70% of the equity and you're going to use the money for a specific purpose, those terms, those interest rates, closing costs are going to be better the less you borrow because it's a lower risk mortgage, right? And also, talking about Texas cash outs and home equity loans, Texas is interesting. I think other states probably have a similar law. We're a judicial foreclosure state. And what that means is for a bank to foreclose on an owner-occupied, on an occupant, owner-occupied house, they have to go through the court system. You can't just miss a payment and then you're foreclosed 31 days later and you're kicked out of your house. It's a very long process for a lender to foreclose on an owner-occupied because we have very homeowner-friendly laws in Texas. The homestead laws here protect the homeowner in every way possible. And so that process of going through the court system to foreclose makes it more expensive for a lender. It makes it harder to evict and foreclose on a borrower, protects you as a homeowner. And so that's a higher risk for banks. So the interest rates are going to be higher in some degree. Like your interest rate on a cash out mortgage is going to be higher than your interest rate on a purchase. They're not the same type of mortgage, right? So that can add to some of the costs. Surprising to sometimes. I'm looking at rates with clients. They say, "Wow, I see rates online or this, and you're quoting me that a lot higher." Yes, because of the type of loan, right? So they're not all created equal. Not all the different mortgage instruments are created equal out there. Purchase loans versus a rate and term refinance versus a cash out refinance. So again, to what you said, Jeff, I mean, that's why you need a loan specialist. That's why you need someone seasoned in the industry to walk you through these different options and present different
Yeah.
various options to you so that you can choose and you can be involved in that decision. And you're not just taking whatever the lender said, hey, this is our the best we have to offer, take it or leave it. No, this is a interactive process where our clients and our homeowners are evaluating their options and really making the best financial decision with guidance from maybe a financial advisor, your CPA, lender, and we're all working on this together.
Yeah. And as we, look, if you're out there and you're seeing, different banks and different lending entities advertising, which is gonna get very popular. So as we are in a declining rate environment, I'm gonna call it a declining rate
It
environment.
is. Let's go.
Because we're kind of up there, and Powell just made some more announcements from the Federal Reserve of what they're seeing as good data is coming out. The recession might be landing. Who knows when the soon is, but in the future, we're in a declining rate environment. That means all these banks are ready to refi your deal for you, and so they're going to be throwing out all kinds of advertised rates at you. Hey, we can refi you for 5.75. We can refi you for, 5.25, whatever it might be that they're throwing out there. That still might not, even with that rate, it still might not be your best scenario until somebody does that blended rate comparison, seeing all the options for you and figuring out what meets your needs. So a tailored review of your current mortgage and the options available for you is what you want. You don't want just a big box telling you a program. It might not be the best one for you, even if it sounds good.
Yeah, so many factors like how long do you plan on staying in this home, right?
Right.
What are you going to do with the proceeds if it's a cash out? How are we going to allocate these funds? What are we using them for? Oh, and we didn't really touch on home improvements, but if you're using the money specifically for home improvement,
I want a pool.
there's
Let's get a
there
pool.
you need a pool. It's
I need a pool.
127 degrees in the
It was
shade right now.
105
It's
yesterday.
unbelievable.
Yeah.
Yeah. So there are specific home improvement mortgages as well that are in that second lien position or also in a first mortgage position where we do pay off your first mortgage, include the renovation into the mortgage, and depending on your interest rate and scenario and how much you're borrowing and all those things, it may be the best option for you. So the purpose of the funds, like what are you using your home for and what do you need to do to your house and what other debt do you have and what other pieces of your financial picture are you managing, and do you want some guidance there so that you can get a second pair of eyeballs to say, all right, this
Right.
is what I'm thinking I should be doing,
Hmm.
what should I actually really be doing? And so if you don't know these certain loan
Yeah.
products are available, then how do you know you're making the best decision?
Yeah.
So and those renovation loans also work for purchases. I know this is more about debt consolidation and refinancing this episode, but know that a lot of our clients will use the equity in their home to then go leverage and buy something else. So you
Right.
can cash out either a second mortgage or a first mortgage, cash out and then go buy an investment property, go buy a second home. And if that property needs work, there's ways to get the renovation money leveraged for those properties. So you're not using all of your cash. And,
Yeah.
and we know cash is king. Cash savings in this country are at a massive decline. I read an article on this recently. So our savings accounts are getting depleted as a nation, and our credit card debt is escalating. And doesn't that correlate, right?
It's rough out there.
It'd be hard for credit card debt to
Yeah.
escalate and savings to escalate because you
Yeah.
just pay the credit card debt off if you could. So
Right.
we're really seeing that quite a bit, and we'd love to help any instance out there where there's some guidance needed. That's what we're here for.
Yeah. And if you're looking at buying, we didn't talk about buyers. We're talking about people that already own and have a mortgage. But if you're looking at buying, just so you know, these are options that can be for you once you own your home. So this is the beautiful thing of home ownership. We're obviously big fans. It is our careers. We chose to spend all this time doing this for people. But we believe it's the best way to financial freedom. And when you have a huge asset that continues to grow in equity, why not let it work for you? The scenario you had 5 years ago might not be the best scenario for you today. So have somebody that knows what they're doing look at it with you. So that's what we're here for.
Yeah, and there's really, I was taught by my financial mentor, there's really two fundamental ways to build wealth
Hmm.
through real estate and through the stock market, essentially, through your investments, through your 401k, through your retirement funds, right? Those are the two fundamental ways over time. The
Mm-hmm.
tortoise and the hare, that's the tortoise way, right? The hare way to build wealth would you win the lottery, you can inherit it, you can invent something, get it patented, go viral with it. Yes, all those things are possible, but the fundamental way to get on the conveyor belt and sort of slow cook your way to wealth is through home ownership, a primary residence, and a secondary or investment properties, and then also through making sure that you're maxing out your investment vehicles, your 401k. If your company is offering a 401k, you should be taking advantage of it, especially if they match. That is free money. Over time, it compounds. It's incredible what that does over time. So when we're looking at our clients' financial picture holistically, that's also something very important that we talk about. You're buying a home, that's amazing. Do you, after you've bought the home, have the budget to continue to invest and save?
Right.
2, 3, 500 bucks a month, $1,000 a month, whatever you can put in. The 401k max now is it's 15, 16,000 or more, I think, per year.
15.
15. So you can put 1,250 bucks a month into an investment vehicle, and then all that could be matched as well. So part of this debt consolidation discussion is, can we use the house to pay off high interest, unsecured or secured debt that frees up cash flow so you can get back to saving money and putting it in your investment vehicles, putting it away for your kids' college, putting it away for your retirement. That is so, so, so critical. And that has been eroded in recent years with inflation, with the economy, with all the different factors. It's just stats. Like
Yeah.
savings are down and credit card debt's up. And we want to offer a solution for folks out there. There are really good ways to curb that
Yeah.
and to shift that financial picture for you and your family.
Really well said. One last thing I want to put in there was sometimes it hurts to wait to do this. So what the cost of waiting on debt, what you said, you have a client that's spending $3,000 a month on interest. Why wait to fix that?
Yes.
So if you're out there and you have a lot of debt and you hate running those numbers of how much you're spending on interest, it is what you're spending. There might be a solution that can help out today. So please talk to your loan specialist, your favorite one. Maybe that's us. Also, like, subscribe, share to the Lending Podcast. We are here for you with JB and JJ here in Austin, Texas. Thank you so much.
Thanks for being with us.